Welcome to Private Markets 360, where we delve deep into the world of private markets and bring you insights from industry leaders. Today, we're excited to welcome Adam Kanter, a partner in the investment management practice group at Mayer Brown. With over 17 years of experience, Adam specializes in regulatory compliance, counseling both U.S. and non-U.S. investment advisors and firms on a wide range of issues, including the recent changes to the SEC marketing rule. His expertise in navigating the evolving landscape of investment management makes him a valuable voice in understanding how these developments impact the industry. Adam, welcome to the show. Thrilled to have you.
Yes, we are thrilled to have you. And Adam, to start, can you share some insights into your career journey and how your expertise in regulatory compliance has shaped your current role in advising investment advisors and companies?
One of the great things about going to law school in DC is all of the various trade associations and kind of everything that all of the action happening here in the city. And so while I was in law school, I ended up interning at the Investment Advisor Association, which is a trade association for investment advisors, as the name implies. And really got to learn so much about the industry, about the people in it, about their kind of commitment to compliance and their fiduciary duty to their clients. And, it's kind of nerdy to say, but I really fell in love with the business of the investment advisory field and kind of knew that that's what I really wanted to dedicate, in my career to helping, people do the right thing and really navigate a challenging and very complicated regulatory environment. And so, I went from, being an intern to then, graduating, working, coming to Mayer Brown, working at a big law firm. It's a super complicated regulatory space. We like to say that the law, LAW, is pretty simple, but the lore, LORE, is very complicated. And so you have investment advisors that are, by and large, trying to do the right thing, observing their obligations to their clients as well as under the law. But there are just tons of gray areas that they try to find their way through. And really, I see my role as their outside counsel as really trying to find the best path through that kind of marries together the risk tolerance of my clients, understanding the regulatory landscape in which they operate, and then finding that right path through meeting their business objectives, but doing so in a compliant fashion and consistent with their regulatory obligations. So, it's a lot of problem solving. It's a lot of understanding what my clients, what they're trying to do, what they're trying to achieve, as well as, it's certainly as the past few years have shown us, as the kind of pendulum has swung from one side to the other and back again, really understanding what the SEC is interested in, what they're pursuing, and then how that's impacting what my clients are trying to do and try to achieve.
Ever evolving landscape. And I'm sure that you don't have two clients that are identical either.
No, absolutely not. The clients are all different shapes and sizes, businesses, and we are fairly, kind of asset class agnostic when it comes to the clients we serve and the advice they need. So whether you have a hedge fund manager or a private equity fund manager or an advisor serving, doing wealth management for a retail client base, they all have the same fundamental underlying regulatory obligations, but it all looks a little bit different in sort of how that business needs to sort of fit into that kind of standard regulatory rubric.
That makes sense. Problem solving for sure. Well, Adam, thank you so much for that overview. It's always insightful to hear how expertise gets built over time. But shifting gears to the current landscape, there's been a lot of buzz around the SEC marketing rule and broader access to private assets. So, what trends are you observing in the investment management landscape, particularly as it relates to the new marketing rule guidance and the growing accessibility of private markets?
One of the things that we really saw over the last few years was kind of a hesitancy from the SEC and the staff to provide concrete guidance to industry participants. And So when the new marketing rule guidance came out earlier this year, I think it was regarded certainly by me and a lot of my fellow practitioners as a breath of fresh air, as a real return to form for the SEC to not engage in rulemaking or guidance by enforcement, but to get out in front and provide the industry with really helpful information about how they can go about, navigating through that complex regulatory environment. And when the marketing rule was revised a few years ago, it left a lot of questions open. And so now that we can get this guidance from earlier this year, it has really unlocked a lot of ability for advisors to, instead of taking a reasonable but very conservative approach, how do you show a particular investment or even all of the investments of a fund that you're managing and do so in a manner compliant with the rules? And now we do have clear guidance, and that is opening up a lot of opportunities for clients to really present information in a way that their investors want to see it. So I think it was super helpful to the industry. And I don't think, when you sort of take a step back and you think about, well, did that guidance come at the cost of, investor harm or potential investor harm? And I don't think so. I think they really did strike a good balance between, giving the investing side of the community information needed to make informed decisions while kind of giving the sponsor side very helpful, clear guide in how they can present information in a compliant way. And then aside from that, from the marketing rule guidance, of course, earlier this summer, we had the executive order come out from the White House regarding democratization of access to private investments in 401ks. And that's been kind of a huge change. Late this summer, we also saw an executive order come out from the Trump White House regarding democratization of access to private assets in 401ks. And I think this has been an area that I think everyone has really been monitoring for years now. And this, bringing alternatives to 401ks is not a new concept. It's been something that I think a lot of people have had their eye on for a while. There have been private equity real estate funds that have been in 401ks in some manner for, close to a decade now, maybe a little over. That's being broadened out, and a lot of market participants are trying to figure out ways to bring that out and are getting very creative in how they're doing so. And I think, a lot of the kind of market tension regarding private assets in 401ks is not necessarily, sort of a regulatory impediment as much as a lot of, the plan fiduciaries. So there are a number of existing regulatory pathways to allow private assets into 401ks, but at the end of the day, the fiduciary to the plan needs to get comfortable. So that's in one area that a lot of people have been looking at this. And, I think there's also just some fundamental misunderstandings, especially the way some of this is talked about in the press. There's some fear mongering over, oh, well, if the Department of Labor and the SEC do what the administration is asking them to do with respect to this, that it's going to be, well, everyone's 401ks are just going to be invested in private equity funds or venture capital and, taking on, huge risk. As a practical matter, based on, the kind of existing limitations in the law, unless the SEC does something very surprising, what we're really talking about is modest allocations to alternative assets as part of a broader portfolio. So it's about taking, your 2045 retirement fund and putting 5 to 10% of that in alternative assets, right? Which I think, generally speaking, is going to help, diversify risk, provide differentiated kind of upside in different market environments, and, can be a very reasonable thing to do. But I think we hear a lot about people saying, oh, well, it's just a bonanza of fees for private equity managers. And, to be sure, there's money to be made. I think it's no surprise that the alternative investment industry is looking to 401ks. It's sort of the old adage of, why do you rob banks? Because that's where the money is. Why are alternative managers trying to get their assets into their 401ks? Well, that's kind of a huge untapped market in large part.
So, your insights definitely highlight how regulation and accessibility are reshaping the present investment environment. Looking ahead into the horizon, what emerging trends do you see impacting institutional wealth and retail investing, particularly concerning the adoption of tokenized funds?
So when it comes to tokenization, I think it's attracted a lot of attention in the market because clearly there are potential for reducing friction and transaction costs, and then ultimately, reducing costs and increasing returns to investors that can have long-term consequences. And so I think it's everyone is watching the space, everyone is watching those first movers and trying to make sure that, even if they aren't ready to fully commit to tokenization, that they're keeping an eye on developments because they don't want to get left behind. If everyone else has already moved on to tokenization and they are so far ahead and lowering costs and increasing returns for their investors, then you're not going to be able to compete if you are starting from square one by the time you realize, well, that train has left the station and we weren't on it, and we're going to be behind for the foreseeable future. So, I think for a lot of my clients, they are looking really carefully at what's going on. A lot of them not quite dipping their toes in yet to sort of go full force ahead with tokenized products, but making sure that they are ready to move if they really see a lot of those kind of benefits materialize in more than a theoretical way. So it's a huge area of interest, and it's one of these things where, of course, you look back, a few years ago, and cryptocurrency was all the rage, and it was crypto this and digital asset that, and of course some of that has stuck around, but I think one of the real takeaways from that era of hype around meme coins and the like is that the underlying technology of distributed ledgers, I think, has real staying power. And I think the advisors that and funds that are ignoring it may be doing so to their peril, and really should have a strategy for how to keep pace with the technology and how it's going to impact how funds are operated from an operational perspective, and again, ultimately, hopefully, reducing costs over the long term and benefiting investors.
It's a huge untapped market. And I would also say to people, I've had conversations about how many people, when you even are invested in funds in your 401k, do you really understand what's in all of those funds? So I think that, sure, we have to understand what's in these private markets funds, but also it's just more, to me anyways, of a diversification or a way to allow individuals to further diversify.
It's a fantastic question, and I think everyone sort of lives in the shadow of the great financial crisis, and no one wants to become a sort of the poster child for the next crisis, right? And I think when you look at the proliferation of private credit, just as an example, over the last few years, it has really sort of boomed in its importance and it's the position it occupies in the investment space. I think it's simple to look at that and say, oh, well, obviously that's where the next crisis is going to come from, right? But not necessarily. And I think by and large, investment managers, when they think about what they're doing and how it interacts with the markets more generally, I think they are all fairly risk minded of, again, not wanting to be the name on the front cover of the Wall Street Journal. No one wants to be the next Lehman Brothers or Bear Stearns. Those are the names that haunt us today and will continue to do so. And I think it's sort of one of those object lessons of kind of thinking through what you're doing, what risks are entailed, and how it sort of connects into the broader financial ecosystem. So, there's obviously this ongoing tension of kind of the need to, generate returns, for investors and for yourself, because it's sort of grist for the mill. It feeds the machine. The better your returns, the more investors you attract, the more money you're going to make. Absolutely. But also being aware that there is the downside. The more you continue to sort of move up the risk and scale to achieve those greater returns, the more risk you do take on. And so I think it's really about from our perspective, from our client's perspective, making sure that we don't have, issues with style drift, right? So you never want an investor to be invested in a product without appreciating the types of investments that they were being exposed to and the kinds of risk they were taking on. To sort of parallel to the late 80s, I suppose, if you're investing in junk bonds, you want to know that you're investing in junk bonds. So that should be sort of on the page, right? So really, I think when people start getting overly creative about some of the financial engineering to try to increase leverage and jam, what's the label on the page say? Is this a risky product or not? That's where I think a lot of the focus is. It's just making sure that the disclosure, what investors understand is happening, is aligned with what you're actually doing. And when those things get out of alignment, that's when everyone takes on risk. That's risk to the investment manager, that's risk to the investors, and that's risk to the financial system potentially.
And so, how has the liberalization of the Rule 506C influenced the role of data in advising clients? And what benefits do you see arising from improved data quality in the fund sponsorship landscape?
Rule 506C changes from earlier this year. It's another example, like with the marketing rule, of real helpful guidance that kind of can help the industry move in a good direction. And essentially, for those who weren't following those changes, essentially back when the Jobs Act was adopted a number of years ago, I guess we're almost coming up on 10 years now, I think, there was this ability to generally solicit, to use general advertising. A private equity fund could theoretically take out a full page ad in the Wall Street Journal, or go on TV and talk about their fund, as long as they're complying with the stick part of the carrot and stick that goes along with using 506C, which is essentially heightened verification requirements for investors to make sure that they are accredited investors before they invest. But for a number of years, since that rule change was made, most funds did not take advantage of those opportunities because of the kind of looming specter of, well, what does that verification entail? And, it can be a very cumbersome process. And the no action guidance from earlier this year essentially said, well, putting it very simply, if we get certain representations from investors that they weren't borrowing to fund their investment, and they are investing over a certain amount of money, then they are sort of per se verified as far as their accredited investor status is concerned. And that's a huge unlock to simplify that switch over from the traditional no general solicitation, no general advertising private offerings to these new 506C, or relatively new 506C offerings. And, we have a number of clients that are actively either have already made that switch based on the guidance, or are actively pursuing a switch. What I always tell my clients that are thinking about this is, switching from 506B, again, the traditional private offering, to a 506C general solicitation private offering doesn't actually change what you're doing. It changes what you're allowed to do. And so a lot of our clients are, when they make that switch or think about making that switch, they think about, well, once I do this, what am I actually going to do with all of this freedom that's afforded? Am I going to take out that full page ad in the newspaper? Am I going to go on TV and talk about the fund? Or am I going to use some of that flexibility in more targeted ways? And some of that is just sort of the proliferation of data to some of the data aggregators out there. There was always this concern for many years of, such and such data provider, they pulled my performance information from some, a public pension fund has published, their returns in my fund, and this data provider has scraped that data, but it's not correct. There was some sort of idiosyncrasy in that public pension fund and their reporting, and that's got pulled into this public data. And do I feel comfortable reaching out to that data provider to say, hey, those numbers are actually too low or too high, and here's the correct number? And is that very sort of reaching out to the data provider, some form of general advertising or general solicitation, right? And when you switch over to 506C, all of those questions and those concerns, they fly out the window. You don't need to worry about that at all anymore. You have that total flexibility, if you want, to do that outreach. And that, I think, over the long term is going to lead to much higher fidelity in those in the data that is available, and ultimately is going to facilitate, I think, better information for investors to make informed decisions, as well as better comps for the fund managers themselves in how they stack up against their competition. So I think it's one of these things that is going to be a long-term good for everybody. And we may not see some of the benefits of that for a few years as these funds are switching over slowly but surely, many of them, but not all of them. And I think, we'll see how this kind of makes its way both into, marketing materials as well as into investor reporting and comparisons and the like. And, we've obviously seen some market participants that are, taking bets on this, right? And really moving into and doubling down in some cases on their plays in the data space, in the alternative fund space. So it's certainly an area to watch, and I think is going to really, benefit the industry as a whole.
And looking ahead, what is your outlook on the investment management industry over the next few years in general, particularly in terms of any regulatory changes we have coming?
From administration to administration, we saw what I guess will characterize as a fairly aggressive regulatory agenda under Chair Gensler to now, I guess, what I would characterize as a fairly aggressive deregulatory agenda under Chair Atkins. And I think, when I talk to many of my clients, what they really, in their heart of hearts, would they prefer somewhat less regulation? Maybe. What they really talk about is certainty. And so I think, what we have ahead of us is a somewhat uncertain regulatory environment and a very complicated one. And, we've already seen a number of delays of compliance deadlines for finalized rules this year. We've seen delays in the Form PF reporting requirements related to private funds. We've seen delays in the AML rule for registered investment advisors. And we've seen court decisions involving the securities lending rule, as well as the short sale reporting rule. And I think what this adds up to so far is a lot of, fund advisors and other investment advisors that are unsure where to best allocate their compliance and legal budgets, right? Because you have to plan in advance for these changes. And, some of these changes, including some of the Form PF compliance delays, were sort of on the eve of the compliance date. And so you have, fund managers that are ready to switch over to the amended form, ready to go. And then right before the filing deadline, it's gotten delayed. So, it's not quite the Lucy with the football metaphor, but it's pretty close. And so I think it's really, I think for many of our clients, they need to stay nimble. They need to really be on top of, monitoring for these changes, because you don't want to be the only one who doesn't get the memo on, you were spending all of your legal budget in getting prepared for, the changes to the regulation SP privacy rule. Well, what happens if, 2 weeks from now, the SEC decides to delay that too? Well, then you've wasted your budget, or at least you've spent it earlier than you had to, and you could have been working on something else in the meantime. So I think, it is one of these issues where, long term, presumably the industry will benefit from lower costs associated with some of the deregulatory agenda being pursued by the SEC. But it does come at the cost of kind of short-term uncertainty, short-term kind of, not necessarily analysis paralysis of being unable to figure out where to devote your time and attention, but it does put a lot of pressure on, where they should be focusing when there are so many balls in the air.
Well, Adam, great insights. It's clear that staying ahead in this space requires both strategic foresight and adaptability. But before we close, any final thoughts you'd like to share?
I think my real final thought is really just, for all of my clients, the real refrain is kind of just keeping your head on a swivel and keeping mindful of course, the North Star is their fiduciary duty to their clients and is putting their client interests ahead of their own. But as we all kind of keep track and adapt to this, really changing regulatory environment and, just kind of making sure that you're staying on top of developments is really key. And that's everything from, of course, looking at what the SEC is doing directly, looking at what the trade associations are doing and how they're engaging. And, I think for many of our clients that are looking for ways to, obviously not during the government shutdown itself, but when the SEC does reopen for business, making sure that they have an opportunity to be heard. Because I think during these times of regulatory upheaval, if you're not talking to the SEC or having your voice heard through, indirectly through one of the trades, then, you're liable to be left behind. And for our clients that have, interests that differ from each other, certainly some people in the market are going to pull in one direction and some in another. So I think it sort of just behooves everyone to make sure that you're engaging early and often with the regulators, and just staying on top of developments is just so key to the business where we are right now.
Thank you so much for tuning into this episode of Private Markets 360. We hope you enjoyed our engaging conversation with Adam Kanter, partner in the investment management practice group at Mayer Brown. Adam's extensive experience in regulatory compliance and investment management has shed light on the evolving landscape of investment advisory and the implications of recent regulatory changes. From discussing the impact of a new marketing rule to exploring the significance of data quality and the outlook for the industry, Adam has provided us with valuable insights. If you enjoyed this episode, please subscribe to Private Markets 360 and leave us a review. Join us next time as we continue to explore the world of private markets and bring you more insight from industry leaders. Until then, keep thinking critically and exploring the opportunities that lie ahead in private markets.